Hello, welcome to the Tally videos. So today we will start with the accounting introduction. So first of all, we start with the accounting. Accounting is the process of identifying, recording, classifying, and summarizing the business transaction and event which are in the term of money and interpreting the result thereof. So basically, accounting includes accounting can be divided in three parts: recording the transaction like journal entries, classifying the transactions like ledger posting, and summarizing the financial report like trial balance, profit and loss account, and balance sheet. Okay, next question is accounting terms. What is accounting terms? Accounting terms refers to the keyword that are used in the business and in the accounting. It helps to understand the accountancy better. Some accounting terms are business transactions. So what is business transaction? Business transaction refers to the business activities which involves the transfer of goods and service in exchange of money or money's worth. Okay, so transaction can be two types: cash transaction and credit transactions. What is cash transactions? If there is immediate exchange of money, okay, that is cash transaction. And if there is no immediate exchange of money, then it is called the credit transactions. Okay, next, purchase. What is purchase? Purchase is the amount of goods or service bought by the individual or companies for the consumption or reselling them. Purchase is the expense for the business. Purchase is shown in the profit and loss account debit side, and purchase has the debit balance. Okay, next, there is two type of purchase. There can be two kind of purchase: cash purchase and credit purchase. Again, this is the same example. Cash purchase means if we are buying the goods and paying immediately, that is cash purchase. If we are buying and paying later, that is credit purchase. Next, what is purchase return? Return is also known as debit note. Goods that has been purchased but returned to the seller before consuming before consuming due to some reason, for example poor quality or damage, is called purchase return. Okay, purchase return is also known as debit note. Purchase return has credit balance. Purchase, if there is return, accounts payable will be debited to reduce the balance outstanding payable. Okay, it will get minus from the purchase account. Okay, next, sales. What is sales? Sales refer to the number of money that business can be selling goods or services. Number of money that business can earn by selling goods and services. Sales is the income or revenue for the company, and sales has the credit balance. There is cash sales as well as credit sales. Cash sales means when we sell the goods and immediately receive the payment, cash sales. And when we sell the goods but money will be received in future, that is credit sales. Okay, next is sales return. Sales return, goods that has been sold to the customer but are returned to the seller before using them due to some reason like poor quality, damage, etc., is called sales return. Sales return will be credited. Sales return will minus from the sales account. Sales return has the debit balance. Okay, next, what is debtors, customers, or accounts payable? Debtor is nothing but the company, person or company to whom the business sell the goods and services is called debtors. Debtors, customers, or account receivable, all are one and same. What is goods, stock item or inventory? Purchased goods or material that is unsold or lying with the business is called the stock or inventory. So goods, stock and inventory are one and same. Stock can be purchased or it can be manufactured in the factory. Next, revenue. Revenue is the earning or income of the business from its regular activities and operation. What is expense? Expense is the losses that business incurred to run the business operation. Next, what is accounting assumption, concept and principle? So this is nothing but the rules and regulations that are developed to make sure the accountings are accurate and perfect. Some examples of accounting concept are business entity concept, accounting period concept, going concern concept, money measurement concept. Okay, what is accounting? What is accounting concept? So there is dual aspect concept, accrual concept, full disclosure concept, historical cost concept. Next, accounting principle. So what are the accounting principle? Cost principle, revenue recognition principle, matching principle and full disclosure. What is double entry system of accounting? Double entry system of accounting is nothing but recording the transaction in the fold of two effect. One is debit and one is credit. Types of types of accounts. Account refers to the statement where business transaction is recorded of two sides, one is debit and one is credit. Accounts are classified into three: personal account, real account and nominal account. Personal account is nothing but related to the person and real account is related to the assets and nominal account related to the expense and income. Okay, next is golden rule of accounting. Golden rule of accounting. Golden rule of accounting are guidelines that every accountant should follow while recording the transaction. There are three golden rule of account. There are three golden rules of accounting. Okay, first is personal account, second is real account, and third is nominal account. So, what is the rule? For personal account, debit the receiver, credit the giver. For real account, debit what comes in, credit what goes out. For nominal account, all expenses and loss debit, all income and gain credit. Okay, next is source document of accounting. What are the source document of accounting? Accounting cycle start with identifying and recording the transaction in the book of account. Source document serve as a evidence that business has happened. Some source document are example invoice, cash memo or receipt, check deposit slip or withdrawal slip, cash receipt, credit note, debit note, voucher, payment, etc. Okay, next, recording of business transactions. So every transaction affect the financial position. For example, goods sold for cash of rupees 50,000. Here, cash is increasing, stock is decreasing. Here, one business is receiving something and another business receiving something in return. Accounting equation. Double entry of accounting is based on accounting equation. Accounting equation is the relationship between assets, liabilities, and capital. Accounting equation signifies that business assets equal always equal to its liabilities and capital. So the formula for the accounting equation is assets is equal to liabilities plus owner's equity. Okay, next question. Recording of business transaction in the book of account. On the business transaction, once the business transaction happens, source document will exchange between the parties, buyer and seller. It is the duty of accountant that analyze and record the transaction in the first book of account, that is called journal. Example, journal is a book wherein daily transactions are recorded in chronological order. The act of daily recording transaction is called journalizing. Format of journal. So you will see date, particular, LF, debit amount and credit amount. For example of above entry, cash account, debit, owner's capital accounts, credit. Started business with cash. Example of started business with cash. Business started with CAS with cash. So the journal will be as shown below. Okay, what is debit and credit? What is the use of debit and credit? Business transaction involve two aspects, debit and credit. In double entry system of accounting, every transaction is recorded in at least two accounts. While recording the transaction, total amount debited should be equal to total amount credited. Okay. All accounts are divided or classified into 5 heads. Examples: income, expense, assets, liability, owner's capital. Next question. Modern rule of accounting other than golden rule of accounting. So in the modern rule of accounting, debit increase in assets and losses, credit decrease in assets and losses. Debit increase in liabilities, debit increase in liabilities or capital and gain, credit increase in liabilities, capital or revenue and gain. If liabilities, capital or gain is decreasing, then it is debit. If it is increasing, then it is credit. Okay. Now we will start journalizing. As explained earlier, journal is a day book or book of daily record in chronological order. There are two types of journal: simple journal and compound journal. What is simple journal? Simple journal is one account is debit and another account is credit. For example, goods sold to global ID, global IT technologies on credit for 15,000. So there is one account global IT technology and another account sale. So what will be the journal entry? Global ID technology account debit to sale account, or we can write customer account debit to sale account, or we can call it account receivable account debit to sale. Next, compound journal. Compound journal voucher is entry in which more than two accounts are debited and one or more than two accounts are credited. For example, 2nd March 24, company made a payment of rupees 30,000 towards telephone, stationery and travelling expenses, each equally. So there are more than two accounts, that is called a compound journal. So what will be the journal of the above transaction? Telephone bill, that is expenses, so it is debit. Stationery, that is expenses, so it is debit. Traveling expenses is expenses, so it is debit to cash account. Next, practical problem. So how to do the journal entries for below transactions? I started business with cash. Cash account debit to capital account. Good purchased from good purchase from Mohan Electronics, rupees 40,000. Purchase account debit to Mohan Electronics account credit 40,000. Stationery purchase for cash. Stationery purchase for cash 2,000 rupees. So here stationery is expenses. So stationery account debit to cash account credit. Global Technologies open SBI bank account and deposit rupees 50,000. So here bank account debit, bank is receiving money to cash account credit. Cash is going out from the business. Goods sold to Ria Singh for rupees 25,000. So Ria Singh account debit to sale or revenue. Ria is receiving the goods. Next, receive a check rupees 25,000 from Ria. So cash account debit to Ria account. Sold goods to Sri Devi rupees 12,000. Sold goods to Sri Devi rupees 12,000. So Sri Devi accounts debit or account receivable account debit to sale. Good purchase from Neetu Singh. Purchase account debit to Neetu Singh account credit. 16,000 debit and 16,000 credit. Insurance paid by check. Insurance account debit 8,000 to bank account credit 8,000. Paid rupees 4,000 for office rent. Paid rupees 4,000 for office rent. Office rent account debit 4,000, credit cash 4,000. Sridevi pays cash 12,000. Cash account debit to Sridevi account. Payment made to Neetu Singh and discount received. And discount received. So here we are making the payment and receiving the cash discount. So the entry will be Neetu Singh account debit, discount account debit to cash. The next entry, cash 30,000 received from Sohan and discount allowed. So here the entry will be cash account debit to Sohan account to discount allowed account. So this was our first step, journal entry. Second step starts ledger posting. Second step start with ledger posting. This is the in accounting process. This is the second step. Second step. First step, journal entry. First step, STEPS steps in ACCOUNTING accounting. First step in accounting is journal entry. Second step is ledger posting. So what is ledger posting? Ledger is the principal book of accounting system. Ledger is also called book of second entry. It is called as final entry. It contains all account of same nature. Example, purchase ledger contain all purchase. Balance from journal book are posted in ledger account. So the example of ledger is given below. Date particular debit amount, date particular credit amount. Need for the ledger. Why the ledger required? Accurate and systematic accounting plays vital and significant role in growth of companies. Ledger as a record of business transaction hold the great importance in accounting. Net amount all transaction net amount of all transaction net amount of all transaction can be ascertained from ledger. For example, how much amount company has to receive can be ascertained from customer ledger. So, to get the true pictures of financial status, ledger is very important because it gives the exact balance of all account. Okay, next question is difference between journal and ledger. What is the difference between journal and ledger? Journal is the book of first or primary entry. Ledger is the book of secondary entry. Journal is recorded in chronological order. Ledger is recorded in analytical order. Journal is classified based in transaction. Ledger is the basis. Account is the basis for classification of ledger. Accounts is the basis for classification of ledger. Classification of ledger. Processing of recording is known as journalizing, and process of recording is called the ledger posting. Okay, next question. Class of accounts or classification of accounts. Class of accounts or classification of accounts. What is class of accounts? The accounts are classified into 5 categories or 5 class, namely income, expense, assets, liability, capital. So next we will see how to do posting from journal. This is the second stage in the accounting cycle. So suppose we have purchased goods from Mohan. So we record okay, we have paid the cash. We have paid the cash for the purchase. So by purchase we will record 40,000 and closing balance we will record to balance CD. When you prepare purchase account, when you that when you purchase the prepare account, so we will write the entry in purchase side but with the opposite name. Suppose purchase from Mohan Electronics, so to Mohan Electronics 40,000. Then next purchase is from Neetu Singh, so we will write to Neetu Singh 16,000. So debit side total become 56,000 and credit side we need the equal amount. So we will write by balance CD. So third step in the accounting cycle is trial balance. Trial balance. Third step in accounting cycle. Third step in accounting third step of accounting, okay, cycle. So what is trial balance? Trial balance is a statement showing the balances or total of debit and credit of all account. Trial balance Trial balance is a statement of showing the balances of all ledger. Trial balance. Trial balance is a statement. Trial balance is a statement showing the balances of all account. Showing the balances of all account. Balances of all account or total debit or credit of all account. Total debit or credit of all account. It is prepared to find arithmetical accuracy of posting from journal to ledger account. This is prepared to find out the arithmetical error of from posting journal entry to ledger posting. From journal to ledger posting. Okay, next will be the adjustment in the trial balance. Suppose we have some outstanding or some advance received after preparing the trial balance, then we will do the adjustment. So after the adjustment, we will prepare the adjusted trial balance. That I have not mentioned here. I will mention it. Adjustments. Adjustments. Then we will prepare adjusted trial balance. ADJUSTED adjusted TRIAL trial PALANC balance. Adjusted trial balance. So what is the adjustment? Suppose there will be some transactions which is posted after preparing the trial balance. So the effect of those transactions will not include in trial balance. So we will prepare one more trial balance called adjusted trial balance after taking the consideration of adjustments. Okay, next method of preparing of trial balance. So there are basically three methods of preparing the trial balance. Number one, total method. Number two, balance method. Number three, total cum balance method. Okay, next is trial balance format. So how the trial balance will look? Date, particular, debit amount, date, particular, credit amount. Okay, next is subsidiary book. What is subsidiary book? A small business or company records all their business transaction in single journal that is called journal book, but in large organization Journal entry is recorded in different journal book that is called subsidiary book. Some example of subsidiary book are cash book, purchase return book, sales return book, journal proper. Okay. Next is control account. So what is control account? Control account are a account which is prepared to keep the journal ledger balances in main account like assets, liabilities. Okay. So control account contain the consolidated and correct balance which can be used in the financial statement. Control account balance for particular period transferred to profit and loss account and balance sheet. Okay, next question. After the adjusted trial balance, we will prepare first is journal entry, second is ledger posting, third is an adjusted trial balance, fourth is adjusted trial balance. This is the fifth. This is the fifth step in accounting. This is the fifth steps in accounting. What is the step? Preparing the MIS report, financial report, management information system, financial report, that is trading account, profit and loss account, balance sheet. Okay, so what is trading account? Trading account include the buying and selling of goods or services without considering the administration, selling expenses, financial expenses. Gross profit or loss transferred to profit account. Prepared to know. It is prepared to know. Prepare to know. Prepare to know gross profit or loss. WHICH, which is transferred to profit and loss account. What is profit and loss account? Profit and loss account is a statement which shows the indirect income and indirect expenses, and this includes selling and administrative expenses, depreciation, interest and taxes. It helps to ascertain the net profit earned or loss incurred in the business. Okay, so next financial step is balance sheet. Balance sheet is a financial statement that shows assets and liability of the company. It shows financial position of the company. Balance sheet helps companies long-term strength and goal, companies efficiency in working capital, assets over liabilities. Next important financial report is cash flow statement. Cash flow statement is prepared or a statement that shows companies cash inflow and cash outflow over a period of time. Cash inflow, customer payment, interest earned, sales of assets. Sales of assets. These are the cash inflow. Cash outflow, includes a salary payment, payment to supplier, loan payment, maintenance of business premises, dividend payment. So these are the example of cash outflow. So basically accounting includes or process these many things. I hope this document is helpful to you. If you want this document, you can give your WhatsApp number. Thank you for watching the video. We will see in next video.